All right, yes, as requested, we are going to go over market structure. Now, I did not go over market structure as a core component in this particular enrollment, in this advanced enrollment. In other enrollments, I do go over that as core component. And the reason why I didn't want to go over market structure in this enrollment is because I felt like the enrollment itself was already advanced enough. Now, to add on to that, and to add the understanding of market structure, because I can understand, and there are a lot of people as well that really love market structure. Now, market structure, the first thing you need to know though, is that you need to be able to use it on the right time frames. So my first question to you is, if you want to use market structure and you want to look into it, you need to know on which time frames you are going to use market structure. That leads me to say, you need to know what type of trader you are. Are you a position trader? Are you looking at monthly swings and you're looking at potentially holding for a year or something like that? Are you a swing trader looking for a week to hold, maybe a few days? Are you looking to day trade or scalp, etc.? It's very important to answer first because that allows us to understand on which timeframes and which timeframes here are relevant for your market structure. Now, with that being said, let's dive into an intermediate term high and intermediate term low as well. I quickly want to go over it because I already went over this in the enrollment as well, just to refresh your mind. A short-term high and a short-term low, because we use intermediate-term high, intermediate-term low, short-term high, and a short-term low. We do not use long-term highs, long-term lows, all irrelevant. A short-term high and a short-term low is simply said swing highs and swing lows. That's it. That's very simply said. That is a short-term high and a short-term low. Now, a short-term high and a short-term low is going to be the same as an order flow lag, most likely, because in order for a short-term low to be strong, it needs a fair value gap in a lag. So the fair value gap creates a strong short-term low. So this, for example, is a short-term low. Now, whenever the short-term high is created, is not super relevant. The main reason or the main relevant thing is the short-term low that creates a fair value gap right there. And that becomes a short-term range. In other words, that is also an order flow lag. So that's the exact same thing. Short-term high is the exact same thing as well. Now, the next thing we need to understand is an intermediate term high, intermediate term low, where again, this, for example, is an intermediate term high. Why? Because this is a swing high with a lower swing high to the right of it and a lower swing high to the left of it, right there. So these intermediate term highs and intermediate term lows are overall on the longer term the stronger highs and the stronger lows. So what we will see over the longer term is that we will respect intermediate term lows to target intermediate term highs. So either we are always looking to target intermediate term highs or intermediate term lows. If we are targeting intermediate term highs, then the intermediate term lows are protected. Like in this case, the intermediate term lows here at the bottom are protected and we are targeting intermediate term highs in the form of these right there. Now, then the interesting thing comes because that really depends on the time frames you are using. Because this right there is an intermediate term high on the monthly time frame. If I go into the yearly time frame right there, then that isn't an intermediate term high anymore. Or do I need to go a little bit higher actually for that? Let's go into the 24 month right there. It's not available. Perfect. But that then becomes a whole different high. So that is very important to understand. Because then you would be talking about a short-term high or a short-term low, for example. Where this short-term low, sitting right there on the monthly, is an intermediate-term low on the weekly, on the daily, for example. And the reason that is important to understand, because that allows you to also navigate the time frames correctly. Where if you want to be a day trader or a scalper, are you going to apply market structure on the monthly time frame? Absolutely not, because I am simply not interested in what the monthly is doing in about 2.5 years. Because I can now see we are respecting intermediate term lows. We might make this retracement, but this intermediate term low right there is respected. Again, don't get me wrong, that could be quite relevant information overall. But the thing is right there that is going to take way too long. We might be in 2027. Perfect. that is not interesting for me unless I am position trading and I actually want to take trades off the monthly right there. That could be very interesting. Now, that is why you have to use market structure on the right time frames. So if it helps you to use market structure on the 50-minute, on the 1 minute as a flow trader, for example, to get to a bias, that is extremely beneficial for you. Now, intermediate term highs and intermediate term lows are outsiders, and I want to go over a few different examples as well. Where if we take a look at ES right here, and we were to use not market structure on the monthly, simply said because we are not position traders. Again, if you are a position trader, then yes, this is exactly for you, right? Then you want to use the monthly time frame and you want to use market structure on the monthly time frame. On the weekly right there, we can see overall that we do have some market structure developing here. Intermediate term highs and intermediate term lows, protected highs and protected lows, are outsiders, as I like to call them. So yes, you can be extremely picky about your intermediate term high and intermediate term low. You don't need to be. It doesn't need to be super mechanical. It is just simply with like drawing with a loose hand. Just very simply, all right, perfect. This, for example, is an outsider high right there. Why is that an outsider high? Well, very simply because there's no high above it. And this, for example, is an outsider low right there. And with those outsider lows and outsider highs, I mean highs and lows that clearly made a shift in the overall market, that are extremely clear intermediate term highs and intermediate term lows. The same as a fair value gap needs to be extremely clear, not a small, miserable, small, tiny fair value gap. No, it just needs to be extremely clear. So here, overall, the market structure is continuing higher currently to take out this intermediate term high. And after we take out this intermediate term high, the low that is now protected is this intermediate term low right there. So then we can continue higher like that. That is market structure on the weekly, where if we define that a little bit more, we go into the daily, for example, we have more outsiders, because now we could argue that these right here are the outsiders. And we've now taken the intermediate term high to the left. We can now make a retracement, but the intermediate term low at all times is protected right there to continue higher. That's important. If we are targeting that intermediate term low, then we are definitely going lower and very low as well. That is important to understand. Now, this as a scalper is not super important. It's not super relevant, right? Because it just simply takes too long. That is why we look at order flow, because it's more zoomed in, where market structure could be the first thing you do, but it's to get the overall direction. So market structure is very zoomed out, where order flow is zoomed in, and candle sign is the last zoom, where you focus on the last actual candle. What is the next candle actually doing? That is very important. So if we go into the 1 hour, then this, for example, could be extremely beneficial for you as a flow trader, where right there, if we now go over our market structure, we overall have, if we start here, we had some bullishness right there, turned into a little bit bearish price action right there, turned into an intermediate term high right there, which we did not take it high. If we now get a new intermediate term low, then we can continue lower off of that. All right, this is still pretty zoomed out. We want to get a more accurate, a little bit more accuracy. Then we can even go into the 15-minute to see what are we doing on market structure right here. Well, intermediate term high, intermediate term low, intermediate term high, respecting the intermediate term highs there as well. Continuing lower off of that, creating even smaller market structure in here. Where if we go into the 1 hour and we use that small market structure right there, we continue lower. And then that is exactly how you eventually as well get to an overall direction more clearly, but you get to order flow as well. So that is how I would advise to use it. You look at, very simply said, overall the outsiders. What are the intermediate term highs doing? What are the intermediate term lows doing? What is the direction they are pointing towards? That is very important. So to go over another example. On the dollar, for example, right here, we can see that if we take a look at the 4 hour, not the most beautiful example, but we have an intermediate term low, intermediate term high right there, retracement, and we create a new intermediate term high potentially right there. Now the intermediate term low right there is protected. So just by these swings, we already understand, all right, I think we might be bullish, to target this monthly VI gap. So it helps with direction. And it helps with, based on the foundation levels, it helps with the bias, right? Helps with the bias, not with the narrative, not with the context, because the narrative is too vague. Yes, we know we can continue higher off of something in this area. That's a lot of choice. That's a lot of choices that we can potentially make right there. That is where order flow comes in. That is where candle signs eventually comes in. So this is how you need to balance out market structure. That is very important to understand as well. Other than that, it's not necessarily very beneficial, I would argue, more so because if we go into the very specifics, it turns more so into order flow. It's also why I did not want to specifically incorporate it into this enrollment. So if you want to use it for your direction, but then you need to know what type of trader are you? Very important question. All right, perfect. Thank you.